One common form of liability is when companies are paid in advance. Imagine Apple announces a new product. You love Apple, so you rush to the company and you put down $100 of a deposit. Apple receives the cash, they increase their cash account, they cannot recognize revenue because they did not sell you anything yet. So they put that under liabilities. They call it a deferred revenue. This is to show that they owe their customers. There is no income when they receive the cash. Do not forget. Now next year, they ship you the product. It costs them $40 to manufacture. They record revenues of 100 and the COGS of 40. Net income is 60. We have a mustache. And retained earnings is 60, and net income under the CFO is 60. We do the accounts receivable adjustment and the deferred revenue adjustment of minus 100. The CFO is down to 0. There is no cash in this period. In the balance sheet, we have less inventory and less liabilities. We do not owe the customers anything anymore. Companies also have to report a whole lot of provisions and reserves for future cash outflows that might arise because of transactions done today. In other words, imagine there is an economic activity done today which would lead you to pay in the future. You need to recognize that future obligation today. If you sell a product and you provide a warranty, then future warranty expense have to be put as a liability today. Imagine you sell a smartphone for $500 today, and you expect that the average smartphone will lead to a warranty cost of $50 in the future. You need to do a provision, and this is under liabilities. Please note the mustache effect on both the CFO and retained earnings. Now in the future, assuming $30 of warranty costs come up, then you reduce your warranty liability by the same amount. However, you do not put anything under the income statement. The expense was already recognized in time t equals 1. Right now, all you have to account for is the fact that you paid $30 for the warranty. Cash is less, and the CFO is less by 30. Companies make estimates like these all the time for warranties, employee bonuses, pensions, maintenance on assets, and severance payments. All these involve estimation, uncertainty, and of course, a very nice, healthy dosage of accounting manipulation. You have a nice bonus this year, you're getting married and want to make a big party, just reduce these expected future expenses as much as you can. Tell the auditor that the new products are far superior in quality compared to before. Put a lower number on warranty expense on your income statement. Leases is one topic that is hard to understand. The accounting for it is complex. I will make a simple explanation here, and for further details, please see my book. There are two types of leases. Operating leases, which are for less than a year. Assume you rent a car for a few days. If you rent the car for 3 years, then it is a financial or capital lease. The accounting for these is very different. In the case of the operating lease, you record a rent expense, make the mustache, and lower the cash. In the case of the financial capital lease, if you rent something for more than a year, you have to recognize an asset. It is as if you own it. Why does accounting force us to put an asset if you do not own it? The reason is simple. For many years, companies would rent an asset. Assume you are an airline and you lease a plane. Such leases could last for 20 years. Companies would have access to a plane for 20 years, but would not show the liabilities for it. Essentially, companies would have a lot of liabilities to the leasing agency, but would not show these debts. Accounting said, this is not good. If you have debt and you use an asset for 20 years, just show it. So now, if you rent something for more than 1 year, you have to show the asset and the debt. Let me show a simple example. Assume you got a car with a present value of $40,000. you have to pay 5 years worth of 10,000 each year. 2,000 of this is interest, and 8,000 is repayment of principal. Moreover, the depreciation on the car that you do not own is 6,000. When you start the lease, you show the asset and the liability of 40K. In the first period after usage, you put the depreciation and interest expense on the income statement. You do the mustache. Retained earnings is lower by 8K, and the net income under the CFO is lower by 8K also. Depreciation is not cash, so we add it back. Under the CFF, we show that we paid 8K of principal, and under assets, we reduce cash by 10K and depreciation by 6K. Under liabilities, we reduce the principal payment. It balances and it is easy. Assets less by 16K equals to minus 16K under liabilities and equity. Ta-da! I am kidding. The slide before was quite complex. Let us simplify it a bit, all right? Leasing an asset is just like borrowing and buying an asset and paying the interest and principal back yearly. In other words, you pay interest, you pay principal, and you depreciate, because it is as if you own an asset. So it's 3 steps. If you break it down, it becomes only 3 simple steps. I love this lease accounting rule. I really do. Now, companies no more hide assets and liabilities. They do not hide their leverage. If one company borrows money to buy a plane, the accounting will be identical to another company that leases the plane. At the end of the day, you control the plane whether you own it or not. And you have debt and you have interests. So we can now easily compare companies whether they lease or they buy. It is now much simpler to compare. Thank you, accounting. You give me a heart attack most of the time, but sometimes you do a bit of good.